Street Week with Louis Rukeyser is made possible by the Corporation for Public Broadcasting and by the annual financial support from viewers like you, by the Travelers Insurance Companies. Over 30 million Americans benefit from our insurance, financial services, and managed health care. The Travelers Insurance Companies. By MFS. MFS helping mutual fund and institutional investors achieve their financial goals since 1924. And by Prudential Securities. With more than 5,600 financial advisors nationwide, Prudential Securities can help you invest your money wisely. Produced Friday, August 5. Tonight's special guests are Stephen Girsky, auto analyst, Payne Weber; Paul Karos, airline analyst, the First Boston Corporation; and John J. Rohs, hotel and restaurant analyst, Wertheim, Schroeder and Company.
Good evening. I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week of some truly bizarre mergers in America. QVC, whose Barry Diller had gone hunting for CBS, wound up agreeing to be taken over itself by Telecommunications and Comcast for $2.5 billion. Easily the biggest sale ever made on the home shopping network, with or without an 800 number. But American Home Products made that look like zircon bracelets after 2 a.m. by offering no less than $8.5 billion for American cyanamide. Nextel, meanwhile, pulled off 2 deals at once that gave it the means to create the first nationwide wireless phone system, a tax-free merger with Dial Page, and the acquisition of all of Motorola's specialized mobile radio licenses. And as if that weren't stunning enough, we had the announcement this week of the absolutely weirdest big money merger of all, the improbable marriage of Michael Jackson and Lisa Marie Presley. Could it really be true that that one went for a song? In the other cases, people scurried to consult industry experts. In this one, the opinion on which most folks speculated was that of Elvis. And for the moment, at least, he ain't talking. But as America's corporate battlefields began to suggest that the national bird should be changed from a bald eagle to a hairy vulture, there was one undeniable lesson from all these aggressive takeover bids. A significant number of the nation's shrewdest investors still plainly believes that many stocks are selling too cheap, and they're willing to put their shareholders' money where their mouths are. Wall Street itself, meanwhile, continued in the summer doldrums, caught between wondering whether the recovery is ominously slowing down after 3.5 years, or whether it ominously isn't. The recently reviving bond market reached the latter conclusion after a government report showed that more jobs than expected were added last month. Bond sellers not only pushed the yield on the 30-year Treasury bond back over 7.5%, but they spooked the stock market into a losing week. The feeling was that if the Federal Reserve, which can spot a wisp of inflation faster than a takeover artist can spot a potential bargain, is looking for an excuse to hit the economy with another short-term rate increase, this could be the rationale it needs. And if all this just convinces you that these fellows could use a nice long vacation, you've come to the right place. Our annual special program on travel. We Americans are notoriously peripatetic at the worst of times. And with the economy continuing to improve, however fitfully and unevenly, a record summer travel season is underway. But what does that actually mean to the industries that make the autos, fly the planes, and run the hotels and restaurants? Can we who feed their coffers also make a buck by investing in these companies? Get ready to provide a little traveling music, maestro, as we find out, with the aid of 3 of Wall Street's most astute observers, where the bargain tickets really can be found. But first, let's check out the stay-at-homes in the financial markets. And as the Dow Jones Industrial Average indicates, traders who took encouragement earlier in the week from hints of slower growth in the housing market and elsewhere went the other way when the bond market took flight on Friday, and the Dow wound up with a net decline of about 17.5 points at 3747.02. and similar small losses were taken by all the broader market indexes except the Amex, which is on a 5-week roll. But looky here, for the first time in 16 weeks, one of our 10 chief elves has actually moved. Alan Shaw changed his vote on the Dow's next 6 months from bearish to neutral, citing what he called the possibility of a somewhat firmer bond market. That moves the consensus to a still bearish -3, but hey, any movement at all from those elfish technicians is headline news these days. As if to mock the pleasures of summer, traders were particularly tough this week on makers of autos, technology, and iced tea. Not exactly the funnest guys to invite on your next picnic. Nor was there much joy to be detected in a mixed currency market or a perennially disappointing gold market, which took its 4th straight weekly hit. Whatever happened to romance in this age of the aggressive takeover? Don't they know Michael Jackson is likely to be buying a lot of their products very soon? Now, before we meet tonight's special guest, let's take a midsummer look at travel in America and find out what we really encounter when we go
on the road again. Just can't wait to get on the road again.
According to the Travel Industry Association, 74% of America's adults, about 3 out of 4, have taken at least one trip in the past 12 months. And most likely the trip really was on the road. 80% went by car, truck, or recreational vehicle, 16% by air, 2% by bus, and 1% each by rail or ship. Where were we headed? The most popular destination in the U.S. for summer pleasure travel is Florida, followed by California, Hawaii, New York, Texas, Washington, D.C., Nevada, Colorado, Arizona, and Alaska. And what do we do when we get there? The most popular vacation activities in order are going to the beach or lake, visiting friends or relatives, visiting a city, visiting historic places, camping, hiking, and climbing, fishing, attending cultural events, and visiting a theme park. The Industry Association reports that 46% of vacationers say they intend to take their kids along, defying the old canard that insists that there are 2 ways to travel: first class and with children. What's the outlook for the industries that take advantage of Americans' historic restlessness? With me tonight are 3 top experts on those industries. In each of the last 2 annual Institutional Investor magazine polls, Stephen Girsky of Paine-Webber has been voted the #1 auto analyst, and he also ranks first in judging the tire and rubber industry. Paul Karos of the First Boston Corporation, now known as CS First Boston Corporation, continues to lead the field among airline analysts. And John J. Rohs of Wertheim Schroeder does double duty as a top-rated analyst of both the hotel and restaurant industries. Gentlemen, you were all with me last year. This time you gave us some valuable insights into your industries. What's been the most significant change since then in each of the industries you cover? Steve?
Well, Lou, a number of the factors that were driving auto stocks last year seem to have turned more neutral. First, car demand, which was accelerating quite rapidly, really on into the first quarter, has slowed. A combination of higher rates, a combination of shortage of hot-selling models seems to have slowed the car market. Another factor is Japanese competition. Japanese competition was really on the run a year ago, now seems to have rallied back, this despite the continued appreciation in the yen. Material cost inflation, which was very moderate for the last few years, now looks like it's picking up. In addition, a number of companies have announced capacity expansion. This at a time when the market's slowing raises the specter of increasing competition.
Those stocks were hit pretty hard this week when one of your fellow analysts downgraded them. Do you regard them as suitably downgraded yet? Are they attractive?
Really, we are much more selective in the market now. We think the car market, the growth is decelerating or slowing down. In that kind of environment, it becomes much more of a game of winners and losers. We think investors are going to go from focusing on the relative strength of the car market to the relative strength of the participants. So Ford Motor Company is the only one I'm recommending right now.
Good. We'll come back with some detail on that. But Paul, first tell us what you think is the biggest change in the airline industry in the past year.
Well, there's a number of things. The One of the biggest things is that a number of airlines have tried to copy Southwest Airlines, who has been growing very aggressively. Airlines like Continental Airlines have started Continental Light. United Airlines has started U2 or the United Shuttle, all in an effort to try to compete on a short-haul route structure that Southwest has become very successful on. The second thing that's happened is we've had a number of startup carriers that have exploded. I mean, literally, we've seen the industry go from none of the industry hardly any startup carriers to over 3% of the industry now startup carriers. And the last thing we've seen is a big round of new cost reductions that the industry has announced that is very aggressive in nature and involves employee ownership in some cases as well.
With all those new entrants, does that mean there are too many airlines chasing too few passengers?
As of right now, the answer is yes. It's been a slower start than expected this year, but I do think that there are certain carriers who are not as exposed to the startup carriers that have a pretty good outlook for 1994.
And if they're all cutting costs and going for a lower price, does that mean service will get even worse?
I do not think you should expect any service in the United States to get better in the next year, that's for sure.
John Rohs, how about in the areas you cover?
Well, over the last year in the restaurant business, there's not a heck of a lot that had changed up until the last few months. It was sort of steady as she goes, solid if not spectacular performance. In the last 3 or 4 months, however, things have softened up a bit, and we suspect that probably has to do with a consumer who's just a little bit more cautious than they were over the last several months, probably because they're reading the same economic news that you and I are. On the hotel side, however, things have really picked up notably over the course of the last year. Demand is extremely strong for rooms right now, and very importantly for the industry, they're finally starting to get some price relief. As a matter of fact, the quarter that we just finished up, the June quarter, was the first quarter since 1987 in which the industry was able to meaningfully price in excess of inflation. So things are looking pretty good there.
So people may be eating less because their hotel room costs are going up.
Could very well be.
Steve, let's come back to the autos. You've already told us that the only one you like right now is Ford. Tell us why.
I think in a slowing car market, it becomes much more of a game of who's the low-cost producer, who's got the best product, who can deliver it to the consumer at the best price, and Ford is well positioned to win that game. There's a number of new models coming out, the new minivan that just was launched, a couple new mid-size cars in the fall, an additional Explorer capacity in the first quarter, all of which is much higher margin. In addition, as the market is decelerating here, it's accelerating in Europe. Ford has a lot of exposure in Europe, and this will provide incremental earnings growth. Finally, the balance sheet is extremely strong. There's $14 billion in excess cash at this company. That's about 40% of the market value of the company. It's a safety net to fall back on.
Are you negative or just neutral on GM and Chrysler?
Well, I think there's a lot more risk here. I don't think there's a lot of downside on the stocks, but there's some things to watch out for. GM, for instance, has exposure in Europe, so they like Ford, so they can get some incremental earnings power there. But as the market slows, the North American restructuring becomes much more important for them. It becomes much more important for them to drive costs out of their North American operations at this time when additional capacity is hitting the market. The competition is going to be taking aim at them. In addition, GM's balance sheet's not what it was. It needs to be improved somewhat.
We've been hearing for years about the resurgence, the revitalization of the U.S. auto industry. This year, with the yen getting so strong against the dollar, was a golden opportunity for the U.S. automakers, but in fact they haven't increased their market share against the Japanese, have they?
No, they're down about a point, about a half a point versus the Japanese, about a half a point versus the Europeans.
Why?
This is quite interesting. First, the big three are short on supply of a number of hot-selling products, especially sport utilities, which has been one of the hottest segments in the market. But in addition, the Japanese are learning to compete with the yen at 100. 55% of what they sell here, they build here now, just up from 45% a few years ago. And that's going to continue to grow. In addition, they're hiding a lot of their price increases in lease payments. Their residual values are higher. This enables them to write lower leases. Third, they may or may not be dumping, but even if they are dumping, it's very difficult to prove. B, in order to get anything out of it, you need to prove injury, and it's going to be very hard for the big three to prove injury now that they're making record profits as opposed to 2 years ago when they were making record losses. So I think there'll be little sympathy from the U.S. government and little sympathy from the U.S. consumer.
What are the hot new cars you like?
There's a lot of good stuff coming that's going to generate excitement in the market. Ford just launched a brand new minivan called the Windstar. It seems to be ramping up quite nicely. In the third quarter, they're going to come out with a new mid-size car called the Ford Contour or Mercury Mystique. It's going to have a new engine that's guaranteed for 100,000 miles with no tune-ups. Chrysler's doing very well with the Neon. They also have a new mid-size car coming out in the fall. GM has a whole host of new products, a new Lumina that's just about to hit the market, a new S10 Blazer, which will hopefully claw back some share for GM in that hot market.
Paul, the airline industry is notoriously the only industry that has lost more money than it's made over the years, but is still in business. How long is this going to go on?
It's just amazing.
Is anybody going to make money this year?
Yeah, actually, I am looking for this year to be the first year in 5 years that some airlines will make money. And the two that I really expect to make money for sure this year are American Airlines and Northwest Airlines. And it's probably likely that United makes money as well. Of course, carriers like Southwest Airlines have made money all the way through the recession, so I expect them to be profitable as well.
Given what you told us earlier, that Southwest is going to have a host of new competition, can it maintain its position?
As of right now, the answer is yes. The two big efforts that are out there is the Continental Light effort by Continental Airlines along the East Coast, and then the United Airlines effort, the United Shuttle on the West Coast. Neither of them yet are successful. Continental Light is not profitable yet, and we're right on the cusp of finding out if it's going to be profitable or not. And then United Airlines on the West Coast hasn't really started this operation. It started in October. So the jury's still out if the other competition can do what Southwest can do.
As investors have repeatedly seen this year, doing good business doesn't necessarily mean being a good stock. Which of the stocks do you find attractive?
The two that I like on a very short-term basis are Northwest Airlines and American Airlines, predominantly because they participate in the big east-west flow in the United States. This is traffic from the East Coast going to the West Coast or West Coast going to the East Coast, the long haul, where there's not a lot of startup carrier competition. There's not a lot of Continental Light U.S. Air battle like the East Coast right now. As bloody as can be. You can get very cheap fares in the East Coast right now. So those are my short-term picks. And my sort of 12-month to 18-month pick right now is Delta Airlines, because I really believe that their cost reduction program they have announced is very aggressive, and they will achieve much of what they're setting out to do.
Do you have some sales?
Yeah, the two that I guess I would stay away from right now for sure would be U.S. Air. They just got a proposal from their pilots for a complete restructuring of the company. And looking at that proposal, it does not look, it's just like it's going to work for the shareholders. It's just way too dilutive. The pilots at this point are demanding too much in return, and the shareholder doesn't get anything back. So I would stay away from U.S. Air right now until we see a proposal that maybe can make sense for the shareholder. And then TWA as well, even though it's down to $2, I still wouldn't touch TWA. I think there's a very serious liquidity situation going on at the company, and it's going to make it very tough for them to make it through this winter coming up.
So they could fail by Christmas, in your view?
It is probably a 50-50 chance that TWA will be here, and you know, they're really looking for capital right now. They're aggressively cutting costs. It's just whether they can do it fast enough to keep their operations going.
What's going to happen to fares with all this competition?
Fares right now, at least on the short, you really have to segment. On the short haul, like let's say 500 miles or less, there is no question that they will stay down and maybe even go down more. And that's because of these efforts by these other airlines to get into the short haul. So if you're going to take a vacation that's an hour away, hour and a half away, you should look for very cheap fares. The long haul fares, New York to L.A., New York to San Diego, Buffalo to Seattle, those types of long haul east-west fares are up quite dramatically year over year. They're up about 10%. So it depends what segment you're in. On average, though, I do not expect fares, if you average everything out, to keep pace with inflation. I still think they'll grow slower than the rate of inflation.
What's going to happen to United?
United Airlines is the biggest employee-owned company in the United States, and it's a very, very exciting thing to watch. It's brand new. The management team that has just taken over is getting to know the employees and implementing some of their new strategies. The big question is whether or not they can get labor to participate fully with this transaction, really get behind them and try to offer better service to the public. Whether they can do that is really going to drive whether they can steal market share from their competition over time and really return the company to solid levels of profitability.
John, the hotel business these days is in many cases the gaming business. To what extent are you now a dual analyst?
Well, very much so. Several of the leading hotel companies do have exposure to a substantial extent in the gaming business. Promise, for example, which is probably one of the strongest companies in the hotel business, is actually 20% a hotel company and 80% a gaming company. Hilton, which is another very well-known name, household name in the hotel business, is actually 45% a hotel company and 55% a gaming company.
Are we having an excess of gambling in America from a business point of view?
The way we see it evolving right now is that there will be certain selected markets, what we refer to as local markets, which are really heavily drive-in oriented, people from within about a 100-mile radius. As those markets build up, we do think there's a reasonably good chance that there will be saturation, but not so in the big national destination market of Las Vegas.
So how do you feel about the stocks?
Well, our feeling towards the hotel stocks is extremely positive right now. Promise, which we mentioned, we have rated a 1. We also have DoubleTree, which we think is a fine company in the hotel business, on our recommended list, along with Marriott International. Also feeling positive, although not as aggressive, on Hilton Hotels right now. So we like the group very much, and we would be overweighted.
You've already indicated that the restaurant business hasn't kept up with the hotel business. Does that mean that you're not as keen on their stocks?
Yes, we don't have anything on our recommended list right now in that area, although we have just recently upgraded a couple of stocks because the market has seen the slowdown in sales and brought some of the valuations of some of the top names in the industry back down to what we think is a very reasonable range. So we've moved to a slightly, from a neutral to a slightly positive rating on names such as Brinker International, Outback, which we just initiated coverage on, and Cracker Barrel, and we continue to have our 2 rating on Starbucks, one of the finest companies we know in the business.
You haven't mentioned the biggest, McDonald's. I know people would be interested in what you think about it.
We have been with a positive rating on McDonald's for a while, and we do think that that company is doing a lot of things right. Most notably, they're enjoying a very strong international growth in local currencies, but they are indeed having a bit of a problem when you look at the currency translation issue that has restrained results for them. And their domestic operations, where a number of years ago they were losing a fair amount of market share, they've managed to stanch that loss and, in fact, are regaining share now.
Some of the leading disappointments in the restaurant business have been in the specialty restaurant area. Are there any attractive areas, in your judgment, in the specialty area?
Well, as we look at the spectrum of the restaurant business, we still think that the casual theme specialty restaurant area, if you will, is the place to be. There's good opportunities, obviously, to invest across the spectrum, but that is where the best demographics are, and we expect them to remain so, certainly over the balance of this decade.
Which ethnic food is most attractive from a business point of view?
Well, Italian seems to be one of the hottest in the industry right now. Many of the leading chains are out there with new or relatively new Italian concepts that appear to be doing very well. Mexican continues to do okay as well.
We've talked in the past about some kickback from the old eschewing of 1950s style eating. Are steakhouses doing well or poorly these days?
Steakhouses are doing remarkably well. Many would argue that there's been sort of an echo reaction to the healthcare consciousness of a few years ago. Americans perhaps are still very conscious of their diet, but they exercise that caution a little bit more at home, and when they go out, they like to let their hair down and have themselves a good, thick steak.
So they're not reverting to the old eating habits on a 7-day-a-week basis, but once in a while they want a blowout.
It's good to sin from time to time.
One of the spectacular up and down stories was the initial public offering of Boston Chicken. Want to break a leg for us on that one?
Well, that's not a company we're tracking closely right now, but we know a fair amount about it, and I think that's a real pioneer type of company. It's a breakthrough in the home meal replacement market. Very strong management team, very strong concept. The stock was a skyrocket on the IPO, went back down, and appears to be on its way back up again. Good, strong story there.
Any sales in the restaurant area?
We don't find anything that's worthy of sale right now. There's a couple of stocks we're neutral on, but if anything, we suspect that the industry will improve from here, so we don't think it's a good time to be selling the group.
And do you think the restaurant business will pick up and the hotel business will continue strong?
Yeah, I think the dynamics in the hotel industry are extraordinarily strong, both the cyclical case and the secular case. In the restaurant business, we do think so.
Thanks very much to my guests, Steve Girsky, Paul Karos, John Rohs. Thank you for joining us tonight. Hope you'll be back with us again next week. Then we'll talk with a man who has been successfully identifying the world's major money-making themes for more than a quarter of a century. He's William Newman, Chief Investment Strategist at Kidder Peabody, and he'll be here to tell us which themes he thinks investors should be playing on the profits piano now. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser is a production of Maryland Public Television, made possible by the Corporation for Public Broadcasting and by the annual financial support from viewers like you, by the Travelers Insurance Companies, providing American business with insurance, financial services, and managed health care, the Travelers Insurance Companies, by MFS. MFS helping mutual fund and institutional investors achieve their financial goals since 1924. And by Prudential Securities, with more than 5,600 financial advisors nationwide, Prudential Securities can help you invest your money wisely. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
This is PBS.
WETA's local broadcast of Wall Street Week is made possible in part by a grant from the Johnston Lemon Group, parent sponsor of Johnston Lemon and Company, and by the Eugene B. Casey Foundation.
This program is made possible by annual financial support from viewers like you. And by Sprint, who brings you all the local, long-distance, and cellular services you need to be there now.